Welcome to DSR Consulting. Our goal is to make finance simple, so you can make informed decisions with confidence. In this video, we'll break down everything you need to know about RESP, how they work, how to maximize free government money, and the best ways to secure your child's future. Let's dive in. What is a Registered Education Savings Plan, RESP? RESP is a registered savings account for post-secondary education that helps parents, guardians, or family members save for a child's future education. Your contributions grow tax-free, and withdrawals are taxed in the beneficiary's hands, usually pay less taxes. Now let's talk about the available government grants in RESP. Canada Education Savings Grant, CESG. Federal government matches 20% of your contributions, up to $500 per year, maximum of $7,200 in total per child. Canada Learning Bond, CLB, up to $2,000 for lower-income families, no contributions are required. Additional provincial grants may be available, for example, $1,200 under British Columbia Training and Education Savings Grant Information, TESC. Here is how it works. You contribute money into the RESP, it grows tax-free, and when your child is ready for post-secondary education, they can use it to pay for tuition, books, and even living expenses. There are two types of RESPs. Individual RESP and Family RESP. Individual RESP is for one beneficiary, and Family RESP is for multiple children in the same family. Also, it can be opened by single care provider or jointly as a family RESP. Let's move forward to understand how to open a RESP. Opening a RESP is simple. Choose a bank or financial institution. Provide your child's social insurance number. Start contributing regularly or when you can. Now let's talk about the withdrawal rules under the RESP plan. When can you withdraw money from an RESP? The student must be enrolled in an eligible post-secondary program, college, university, trade school, or apprenticeship. The institution must be recognized by the Canada Revenue Agency, CRA. Types of RESP withdrawals. 1. Educational Assistance Payments, EAPs. EAPs includes government grants, CESG, CLB, and investment earnings. It is taxed as the student's income, usually at a low tax rate. Withdrawal limit, $8,000 in the first 13 weeks of full-time study, no limit after that. 2. Post-secondary education, PSE, withdrawals. PSE is the money you contributed and therefore it is not taxed on withdrawal. It can be withdrawn at any time once the child starts post-secondary without any limit on withdrawals. Now let's understand what happens if child doesn't go to school. Transfer accumulated income payment funds to an RRSP, up to $50,000 if there is contribution room available for subscriber, or else withdrawal are taxed in addition to 20% penalty. Return government grants, CESG and CLB must be repaid to the government. Keep the account open. RESPs can remain open for 35 years in case the child decides to enroll later. Smart withdrawal tips. Withdraw grant money and earnings first to avoid losing government contributions. Plan withdrawals strategically to minimize students' taxable income. If funds are not needed immediately, keep them invested to continue growing tax-free. Things to remember. Want to give your child a head start on their education? Start early to maximize grants and compound growth. Start a RESP today. The sooner you start, the more you can save. If you found this video helpful, give it a thumbs up and subscribe for more money-saving tips. Got questions? Drop them in the comments below. See you in my next video.